Hello everyone. Welcome to the traditional yearly key tax changes in the Baltics event, webinar that started more than 10 years ago as a live event, and only during COVID times it became a webinar. And this tradition is started a long time ago with the Estonian Chamber of Commerce, and a couple of years also supported strongly by Sweden and Norway chambers of commerce. To all of them, we are very grateful for the support. And today, my name is Vykintas Valiulis. I am tax specialist in Lithuania, Vilnius office, and I'm very happy to have a wonderful team of colleagues whom I am asking to present themselves, starting from South Lithuania and going north through Latvia to Estonia. Vilma, please.
Thank you, Vykintas. Hello, everybody. Nice to see you all gathered here. So my name is Vilma Priluckytė. I'm a tax manager. I'm from Lithuania. And today I will represent some tax changes from Lithuania.
Hello everyone, my name is Mārtiņš. I'm head of tax in Thornton, Latvia, and today I'm gonna introduce you with tax changes in Latvia.
Hello everyone from Estonia. My name is Kristjan. I'm head of tax and also trying to give you a useful summary of changes about Estonia.
And I am Urzula. I am a tax manager, and I will give you a really brief overview of the recent EU directives in the field of direct taxation.
All right, and then without any further ado, let's start with Lithuanian key tax changes, what we have new this year. Vilma, please start then.
So let's dig into tax changes in Lithuania. So this first slide, as you see, refers to main tax rates and main taxes in Lithuania. Some of that data is quite old, nothing changed. Some data new, like minimum wage or basic exemption. But since this slide is quite self-explanatory, maybe we will just leave you to it to look at it after the webinar, and just let's move to another slide. All right. So the biggest tax news, I guess, in Lithuania is that our tax reform was postponed. Our current government planned quite a lot of tax changes, like, higher taxes for freelancers, higher taxes for immovable property owners, including residential property. But as in any other country, politicians received so much backlash and criticism, and they just, couldn't agree among themselves as well, and they just stepped back. And our tax reform was really postponed. And taking into account that next year we'll have a lot of elections, presidential elections, parliament elections, elections to European Parliament. So we really guess that no tax reform will come into effect, at least by this current government. All right. However, if we have some tax changes, we have this constitutional court ruling, which says that tax changes must enter into course, 6 months after the adoption. This ruling was announced in 2021. So let's hope if we have some tax changes, businesses, taxpayers will have some time to prepare for them. Or unless, you know, some really difficult economic crisis hits the world markets, then of course politicians will have to step in and you know, adopt something really fast. But at this moment we don't see that, so nothing probably will happen, anything significant during 2024. Okay, couple of sentences about potential defense tax. So, as you understood already, subject on war is today's reality, unfortunately, not only in Baltic countries, but throughout the whole Europe. And in relation to that, Lithuanian politicians are really keen to adopt some new defense tax laws. But however, today we really cannot give any specifics yet. It's just into consideration, but I really wouldn't be surprised if something like that would come into effect with the new government. All right, so now let's move from potential tax changes to real tax changes, and one of the most significant VAT changes happened, you know, for restaurants and catering service companies industry. You know, we had this for more than 2 years. We had this preferential VAT tax regime of 9%. After pandemics, politicians, you know, decided to help restaurants and cafes, and they allowed, you know, to serve food and provide catering services at the rate of 9%. However, this regime ended last year at the end of December. And now new reality will hit restaurants and cafes because they have to go back to old VAT tax rate, 21%. And I think it's quite significant, as you might understand. So what we can expect, just higher food prices in the restaurants, unfortunately. All right, next slide. Personal income tax changes. So payroll service providers, I guess the professionals who work with payroll should pay attention, of course, to our minimum wage was increased up to 924. Then non-taxable minimum monthly income increased up to 747. Our average wage increased from 1,600 up to 1,900. So we provided a couple of links of this information, and you can check more details on when, you know, for what the thresholds average wage is calculated, and so on. Just look at the details in those source links. More about monthly non-taxable income. So as some of you might know, in Lithuania, monthly non-taxable income depends on the person's salary. So there are different formulas which are applicable depending on the size of the salary. So we provided these for you, these two formulas, and please pay attention because different wage, different formula is applicable. Next slide. All right, and we thought maybe we will tell you a couple of sentences about these new rules for settlements with the tax authorities. So before these rules came into effect, basically tax authorities and taxpayers were signing peace agreements, you know, without, you know, those peace agreements were not basically based on any criteria. So it was really vague, and I think quite challenging for tax authorities to decide when they should, you know, take the decision and sign the peace agreement with the taxpayer. But since last year, October, they adopted new rules. And, you know, now just individuals and legal persons will be collecting certain points. And according to those points, tax authorities, you know, basically make the decision whether to sign the peace agreement or not to sign. For example, and we provided a couple of examples that you would understand better what I'm talking about. So, for example, one of the criteria is if a legal taxpayer undertakes to pay more than 50% of the amount of the claim before signing the settlement agreement in the proceedings, so 3 points will be awarded. So, you know, during this process, different points will be awarded, and after taxpayers collect certain amount, tax authorities will take the decision to sign or not the peace agreement. So I think that will be it from me, and I'm giving the word to my colleague Vykintas.
Thank you, Vilma, for briefing about those changes. I would like to continue with the corporate income tax related changes. First of all, some corporate income tax reliefs that were questioned previously were finally prolonged for 5+ years, and 2 tax reliefs were prolonged. The one for funding films production, and the second one for investments into fixed assets, also called investment projects reliefs. So luckily for taxpayers, both tax reliefs were prolonged until year 2028. Also, a corporate income tax relief for very large investment projects consisting of more than 20-30 million euro rules were tweaked from 2025, and we provide a link for more information, as it is quite complex and not easy to summarize in this format. But we are happy to provide more information if this is something that you seek to apply. Some less important information about corporate income tax is that new mandatory disclosure of information is starting. This is coming from EU directives, which will be also summarized by the end by Urzula. We just want to mention it very briefly that for companies, even the smallest ones belonging to international groups of companies that have more than 750 million euro of total global revenue, they will have to publicly disclose their information, such as income tax paid, income, pre-tax profit, etc., on their website, and auditors will also have to audit this information. Similar measures will be in Latvia and Estonia as well, and it starts for most of the taxpayers from the year 2025. unless for those who have tax year starting anytime from June 22 this year, this will start a bit earlier, but not immediately now. Moving forward, we wanted to remind of CSOP for international money transfers related data provision to tax authorities, but this is not new. This was already briefed in year 2022 news, and a first submission will have to be made for the first quarter of year 2024, no later than April 30 and this year. Moving further to some other changes of Lithuanian tax legislation, as you might have heard also earlier, as this is coming from year 22 changes, internet platforms or apps now will have liability to report to tax authorities their users' related data on their income. So it concerns also such popular platforms as Bolt, Volt, etc. And it is also from directive package, which Urzula will mention a bit later. What we wanted to add, however, is that tax authorities see their powers being strengthened gradually, and nowadays they will also be able to block non-compliant internet platforms without a separate court order much faster than before. So compliance is indeed very important. And as you may have heard as well, a list of non-compliant tax haven jurisdictions was amended twice during the year 2023. Russia was added to the list, which was the same that Russia did 5 months ago towards Lithuania and other EU countries. So it is a bit delayed, let's say, move from Lithuania, but still. And also in August, Paraguay was removed from this list, so helping business with South America more smoothly. We hear also quite a lot of let's say public debate about changes of tax authorities commentaries. So we just wanted to catch up on this and express that this is not tax legislation. This is only tax authorities' opinions, interpretations. Of course, they are very, very important, and we must take into account those. So starting with cars, company cars. Recently, this made headlines, as you can see in a screenshot here, that tax authorities now claim that travel, work, home is now treated as by default being income in kind, whilst previously it was claimed that it can be treated as not income in kind. But luckily, let's say we understand that some exceptions still can remain if the work of the employee is such that it can require departure from home directly to work outside of usual workplace, for example, client's site, etc., then it should be still not income in kind. So truly, it is a matter of factual circumstances and debate with tax authorities, for which we recommend written inquiries. To be a bit more, let's say, positive, nothing is not everything is bad, because we also saw from tax authorities this move that they agreed that electric vehicles term should include also plug-in hybrids, allowing for this type of vehicles VAT deductibility, of course, if the car will be used for VAT taxable activities. So it should give a bit of boost to this update of company cars with this respect. On the other hand, tax authorities seem to have a bit restrictive notion of workations and commenting in their commentaries that they do not see them as business trips, but rather as a remote work only, and therefore they do not accept that per diems, non-taxable per diems in Lithuania could be paid for vacations. We are not fully certain whether not any exceptions can exist. It is quite different in all the cases, and if you would see some more complicated situations, don't hesitate to contact us, as it is quite important aspect of taxation. Note also that this is a trend that will stay. Tax authorities' comments will be changed more often, as no longer Ministry of Finance approval is needed. However, courts refuse to allow tax authorities power to invent new, more restrictive tax rules, as only Parliament can do this. And recent case law on tax loss transfer between group companies confirmed that, as court denied tax authorities more restrictive interpretation of what the law was saying. So the key takeaway message here is to remind you that the law is still the primary source for tax rules in Lithuania, and tax authorities cannot invent new requirements, and taxpayers can make their rights count. And we tax advisors are here to help you. So that is all from Lithuania side of key tax changes that we see them. And we now invite Latvian colleague Mārtiņš to brief us about what is going on in our neighbor Priluckytė country, Latvia.
So, hello again. In 2024, there are more changes maybe than in 2 previous years. However, most of these changes, I would say, is related with high level of inflation in recent years. So accordingly, some thresholds has been increased. There we have a slide with the tax rates at glance. I would say that none of general rates has been changed, but the changes is in minimum wage. It is increased from 620 euros to 700 euros. Then we have increased for local VAT registration threshold from 40,000 to 50,000 euros. And all the other rates stays the same. I would maybe just a bit talk about solidarity tax, as this is something we have in Latvia, but such a tax is not in Lithuania and Estonia. So in general, this is the same social tax, but for the social tax, we have threshold of 78,100 euros, up to which we are paying social tax. And when this threshold is crossed, exceeding this threshold, solidarity tax comes in. And this solidarity tax is paid by employer. However, during the year, employer continues to pay social taxes of employer and employee, together of rate of 34.09%. And as we see, then solidarity tax is a bit lower. It is 25%. Therefore, during the year, employer has overpayment of tax, and at the following year, tax authorities makes a refund of this difference between solidarity tax and social taxes. And for example, for 2023, employers will receive this refund in September 2024. So let's move on to the next slide. Let's start then with the changes in corporate income tax. There are some changes for credit institutions and consumer credit service providers. So until December 31st, 2023, said institutions had like a regular corporate income tax system that corporate income tax had to be paid up to profit distribution or deemed profit distribution as all the other taxpayers. But as of January 1st, 2024, said institutions and service providers who are Latvian corporate income taxpayers will be obligated to pay corporate income tax surcharge of 20%. In accordance with the tax changes, calculations must be submitted within 4 months after the deadline of submitting annual report of the company. And for calculations, the previous year financial data will have to be used. This initiative comes, of course, from Ministry of Finance that was evaluating the activity of lenders, and they concluded atypically high profit rates, and mostly those rates exceeded 30%. And profit, of course, was formed mostly from the loans issued and the high interest rates. And the aim of this amendments was to ensure like a fairer interest rate burden between society and the financial sector. Next changes is about a representative car. We have such a terminology in Latvia. A car whose value is exceeding 75,000 euros without VAT is defined as a representative car. And mostly for those cars, corporate income tax is payable for the expenses related to this car, and VAT is non-deductible. And until the 2024, it was regardless of how long the taxpayer owns such a car, it was never deductible. However, from 2024, we have changes that fuel and operating expenses arising from this representative car usage. In case the company will hold this car for more than 60 months, it will not create a corporate income tax base, and also VAT will be deductible. So let's move on to the next slide, please. Changes in value-added tax. So the first is already, as I mentioned, regarding representative cars that starting from 61st month, it will be deductible. Then we have changes also for the bad debts by complying with the provisions of VAT law. Taxpayer is allowed to reduce the VAT amount paid into state budget and without a court judgment on debt recovery and without the Bailiffs Act on the impossibility to recover the debt. If this debt amount do not exceed 1,000 euros. So in case if it exceeds 1,000 euros, we need also a court judgment or Bailiffs Act. So next changes is for payment service providers. So VAT Act sets out obligations to keep records and store and provide information to tax authorities about payees and cross-border payments. And this aim of this amendment or this obligation is to detect and control fraudulent companies and combat cross-border fraud in e-commerce sector. And then we have one change in rates for fruits and berries and vegetables. Before it was 5%, and in 2024 it is increased to 12%. And this 12% at the moment is applicable until the end of 2024. So let's move on to the next slide. It is about personal income tax changes. Firstly, there is increase at the threshold for life, health, and accidents insurance premiums. Now it's increased to 750 euros. Before it was 426.86 euros. Employer paid tuition fees for employee to study at the state accredited Latvian education establishments and EU EEA education establishments will no longer be treated as fringe benefits. and therefore no personal income tax will be applied. However, this obtained at higher education must be related with knowledge and skills which are required by the employer. Then an employer is entitled to cover employee remote work expenses in amount up to 40 euros per month. However, there are some criteria which is mentioned in personal income tax law which must be fulfilled. Say the compensation, but in amount of 30 euros, there was also during the COVID crisis in 2021 and 2022. However, let's say tax authorities and Ministry of Finance has adapted to the situation that a lot of employees is working remotely even after the crisis has ended. Therefore, there is again renewed such a compensation of expenses that can be covered by employer. And from 1st January 2024, contributions to pan-European private pension product funds is treated as PIT eligible expenditures. And this means that the taxpayer can include their PEP contributions in their allowable expenses for the tax year and receive a 20% refund, same as with the tire-free pension plans. So let's move on to the next slide, please. Then we have changes in cooperation with tax authorities until December 31st, 2023. Maybe some of you have been in the program, in-depth cooperation program with the tax authorities in Latvia. And within this program, taxpayers had the opportunity to qualify for 3 levels, bronze, silver, and gold. And in each level, there was various benefits. However, as of 2024, the operation of in-depth cooperation program has been terminated, and there is new era, taxpayer rating system. And the rating is provided to every taxpayer who has obligation to submit annual report in Latvia. Let's say in general, those are companies which is registered in commercial register of Latvia. As tax authorities says, there are 2 purposes. First is companies will be able to see their tax payment discipline in more detail. And the second, company ratings will be publicly visible to possible cooperation partners, customers, and other parties. And they will see the company's overall tax payment performance. So the ratings will be from A to J. And there you can see those small description of each ratings. For example, if company receives a rating A, this means that taxpayer has good payment discipline and no significant risks. In case there is some areas where tax authorities is not compliant with tax authorities, then lower rating will be received, like B or C. Also, those ratings will be revised every 3 months. So in case company has received rating B, after 3 months, it is possible to get rating A. And these ratings are mainly influenced by criteria as whether taxpayer timely submits its declarations and reports, whether taxpayer has received any fines from tax authorities. Also, attention will be applied whether company pay atypically low wages to its employees, and there will be other factors. And also the same as in-depth program before, companies with rating A will be able to receive several benefits. As first, tax authorities mentioned that they are not planning to proceed control measures on companies under rating A. And also there will be faster communication with tax authorities For example, it will be possible to receive answer to written letters up to 10 working days. Also, VAT refunds will be refunded within up to 10 working days. But for others, which is not in rating A, those will be 30 days. Let's move on, please, to the next slide.
Sorry, Mārtiņš, something again. Okay.
Yeah, thank you. There I will quickly just run through the changes in other taxes. So there is increase in interested reporting for the goods from EU. The threshold is increased to 350,000 euros. Then we have increase in excess duty rates for alcohol, non-alcoholic beverages, cigarettes, tobacco products, and e-liquids. There is also changes in natural resource tax. Those changes are, I would say, mostly linked with Latvia's action plan for reducing air pollution in 2020 to 2030. There we can see that we have more objects of natural resource tax, like hydrocarbons, textiles, and plastic containing fishing gears and others. And then we have also increased the natural resource tax rates for packaging vehicles and others. And the last but not least is about the gambling and lottery taxes. The rates is also increased in this. At the end, I would just like to mention maybe the main focus areas in 2024 from tax authorities' side. It will be transfer pricing, the same as the previous year. And also, besides transfer pricing, tax authorities will pay more attention to atypically low wages that taxpayers is declaring. And some control events may be started or some questions could be arising from tax authorities' sides. Thank you for your attention. I'm giving my word to Kristjan.
Yes, thank you, Mārtiņš, and hello again from Estonia. So, as a few introductory comments that the defense tax mentioned in Lithuania as a potential new tax type. In Estonia, it is decided that the defense tax is already hidden into the grease of existing taxes, and with appetite to even introduce some new taxes. So tax rates, maybe go through this very quickly in order to make some comparison comments also to Latvia and Lithuania, and later we will go through some changes a little bit in more depth. So the corporate tax, as in Lithuania, as Latvia, we have deferred tax. Still, it's the same. Still, the same standard rate, 20% on gross profit distribution. It means 25% on the net distribution. And the last year, the reduced preferred rate, 14%, is also applicable and possible to apply on the regularly distributed dividends. So personal income tax, this is a little bit different from Latvia, Lithuania. The rate itself is flat. It means it's not progressive as it is in Latvia, Lithuania. If you later compare these lines. However, the basic exemption, which is the maximum is €654 per month. This is a kind of hidden progressive system because it will be decreased together with the increase of salary, and above 2,100 euro a month, the basic exemption will be 0. So this is a progressive. Social security tax, again flat rate, but what is quite different from Latvia, Lithuania, in Estonia, it's fully employer's obligation. In Lithuania, almost everything employee obligation through a withholding, and somewhere in the middle in Latvia. But in Estonia, yes, 33%, and always have to pay on the top of gross salary. So there is no point to compare the gross salary, either the salary fund in total or the net salary, if you want to compare the salaries between Baltic countries. We do have an unemployment insurance premium, which is also split between employee and employer, and voluntary pension. Minimum wage somewhere between Latvia and Lithuania. I think the highest in Lithuania right now, but it's been also a little bit increased compared to the last year. The VAT standard rate is now changed. This is the highest now in Baltics. It was 20, now 22. We will go through this. Reduced rate right now, nothing changed, but it will be changed soon, next year. And the VAT registration threshold remained the same, which means this is the lowest in Baltics again, because as you noticed, probably 50,000 euro in Lithuania, 45,000 in Latvia. So let's move forward about the value-added tax changes. So as mentioned, the standard rate has been increased now. It requires certain transitional rules, and as you can see, then under certain circumstances, in case of a long-term contracts concluded before 1st of May last year, if depending on the wording of those contracts, then it's a possibility to apply the old 20% rate during the next 2 years. Either it's whatever, the leasing payments or any other long-term service. So that's clearly relevant, particularly relevant also to transactions involving immovables. But nothing can be changed now. It was as it was, because the new law was introduced exactly in the beginning of May last year. So there was no optimization opportunity actually. So what is the next thing is the payment service providers have obligation to store data on recipients of cross-border payments. That doesn't actually have impact for too many taxpayers, but still for some of them. But what is more relevant also to notice is that as of in the next step, as of 1st of January 25, this is already decided, but will be introduced next year. The accommodation reduced rate on accommodation services will increase from 9% to 13%. And also the VAT rate on public press publications will also increase from 5 to 9. So according to the VAT law, VAT directive, you know that each member state could have only 2 preferred rates on the top of the exemption and 0. So we have next year 9 and a new rate 13, which is applicable for recommendation. This is, of course, quite significant change. Will definitely decrease competitiveness in this sector, because it's again will be the highest preferred rate. It's still preferred. Initially, it was a plan to apply even a standard 22% rate to accommodation, which would have been quite catastrophic impact, I think. So yeah, and accommodation will apply also not only in hotels, but those entrepreneurs who are renting out short-term rent through Airbnb and Booking also can now join the 9%, must apply 13% next year. So let's move on to the next slide. Individual taxation. This will apply now for the 24 year, which for which the individual income return will be submitted year 25. Right now there will be a deadline to submit soon individual return for 23. And all of this, which is now here listed here, all those additional deductions available will be abolished, or actually were already abolished from this year. So we have only the one and simple and very robust basic exemption, which is even progressive. We do have some very, very small additional deductions in case of the investments into the voluntary pension system and some other costs regarding the education, but not much. So deduction possibilities are very, very limited, actually, to be honest, in Estonia in case of individual taxation. As of next year, the only good news is that the progressive basic exemption will be unified or abolished and will be replaced with a flat unified exemption applicable for everyone, 700 per month, regardless the size of income. And yes. And as you can see, also the standard rate will be increased from 20 to 22. So it's easy to remember exactly the same as with the VAT rate, as it was before 20 and 20% VAT, 20% income tax, either individual or corporate. From the next year, everything will be 22 again in Estonia. So corporate tax changes. The cross rate it's although we are not applying the cross rate because we have cash-based taxation, it means that we are calculating the netto cross rate, which means from next year, instead of current 25, it will be 28.2%. But if we will compare the tax systems, our Estonian system with a traditional accrual-based systems, then it is more logical to compare the cross rate to be more comparable. So what will also change is the reduced tax rate currently available for the regularly for the applicable for the 3 years average dividend payments, which is particularly interesting and useful for the investors. For the non-resident investors of Estonian companies, either they are individual non-resident shareholders or corporate shareholders. In both cases, it is quite useful right now, this reduced rate possibility in case of positive equity and good cash flow. And then in terms of effective rate, it's much cheaper. However, this is now the last year, 24. If anyone here from Latvia, Lithuania, having investment in Estonian company, having the previous dividend policy within the last 3 years, feel free, and I would recommend to you to exploit this possibility, applicable and possible only during this year. Then if you will pay out the dividends within the 24, then you can still last time enjoy this reduced rate. But as of 1st of January 25, this will be abolished. Even though you may have, as end of this year, you may have the 3 years 3 years average dividend balance may be very, very big and large, but there will be no transitional rules for such incentive. It will be just abolished, and that's all. And for credit institutions also, we can currently enjoy the 14% reduced rate on accrued basis, and that will be increased up to 18 on the accrued basis. And if later those credit institutions are deciding to distribute the dividends, then the difference of 18 and 22 will be paid on the top of that at the time of the dividends. So let's move on. Motor vehicle tax, yes. So this is still, it's not decided. It very likely it will be adopted, but it will take effect as of 25. But still, it's very popular and almost everywhere in all other EU countries. But for us, it's the new type of tax, and has been fueled a lot of public attention, and I would say even tensions in Estonia. It covers mainly the passenger vehicles, but not only. And the problem is that they have been, during the development, they have proposed different methodologies, and some of the components, and especially the values of those components, are still not fully decided. But they are trying to achieve very different goals. Firstly, we want to, of course, patch the hole in the budget, but they also want to sell it to the public as an environmental tax. We also have to take into account that there are like less wealthy car owners, and this altogether is quite a mission impossible to the government to sell it from a PR perspective. Although most of the taxpayers understand that the state budget must be funded. Our defense budget has been increased by 1%, but still it's been fueled a lot of tensions. So in short, although we are not we don't know fully yet what are the exact rates, then all of those components, I mean pollution, vehicle weight and age component, then as an example, based on the latest known version, in case of Toyota RAV4, more than 5 years old, annual fee would be around 250, which the owner has to pay each year, and the registration fee at first registration will be 3,500. So this is a kind of average, but as always with average, if you are owning an electric car, then it will be much less expensive. And in some other extreme cases, owning the large SUV, expensive SUV with internal combustion engine, then the registration fee could be even above the 10,000 euros and many thousand euros annual fee as well. So what I would like to add as a last Estonian specific topic is to also few short comments on the current practice and focus of Estonian tax authorities. Firstly, as a comment to the Lithuanian slides, Estonia have no peace agreement possibility. So, however, it is in the way that although the tax authorities have been rapidly and significantly increased in the last 1 and 2 years the number of inspections based on our experience. And they're also recruiting the new people on the inspection side. Then it is always approached not like a wide-scale revision, but usually the specific cases, inquiries, often not formally, but informally. And during that, if a taxpayer has some flexibility to have some kind of negotiation sometimes, but it's not, we have no legal ground in the taxation law to arrange such a peace agreement with, I don't know, 50% of decrease of a claim, as it is in Lithuania. Only decrease, 50% decrease can be applied is default interest rate. If a tax authority can, or if there is a tax debt, then the taxpayer could apply the application to reduce the interest rate. But otherwise, it's kind of vague. However, if a taxpayer is is willing to cooperate with the tax authority before the formal tax assessment notice is submitted, then usually there are some rule of negotiations and decrease of tax liability, but it always depends on the specific circumstances, of course. So I think that's pretty much, maybe from the tax point, from the inspection side, the tax authorities currently in Estonia pretty much controlling everything. Transfer pricing, documentations, liquidations, which is now more popular. If the shareholders would like to close their companies, then the commercial register is obliged to ask permission from a tax authority. Before that, it was very formal. There were no additional inspection. Now almost all of them will be checked by the tax authority. Permanent establishments, branches often are subject of inspections based on our experience. Restructuring and movements in equity, because the specifics of Estonian corporate tax, again, VAT, especially the real estate and supply chains. And that's all from my side about Estonia, and I will give over the word to Urzula, please.
Thank you. So I'm covering the news from the European Union side about recent EU directives, which finally will land in our national legislation. So here's just a brief selection of a few directives which are already either in force or which are in proposal stages. So for the first Tax 7 directive, as you may have recalled from the last year's presentation, this concerns reporting obligation for digital platforms. And this Tax 7, what it means, DAC means Directive on Administrative Cooperation, which means that tax authorities in the European Union work together and exchange information about taxpayers, about income which taxpayers receive, and so on. So this TAC is 7 in a row, and although it has been in force already from the last year, now is the time when the digital operators, platform operators, need to report to the tax authority information about sellers who sell services, provide services or sell goods through their platforms. So by the end of January, this information will be reported to the tax authorities, and tax authorities will exchange this information between each other in February. So although it is not new, but what we wanted to highlight here from Estonian perspective is that there has been a grey area with regards to income earned by individuals through digital platforms, for example, taxi drivers, food carriers. So until now, there has been like an agreement or a grey area about the taxation of those payments. So until now, this could be taxed only with income tax, and it is actually assessed by the tax authorities that probably only 20% of individuals report such income. So with this directive, the tax authorities also gave a very precise guidelines how to tax these kind of payments. So now it is clear that if the service provider is a private individual and is not registered as a self-entrepreneur, then this payment should be treated as a salary payment and taxed with all payroll taxes. So the platform operator will need to withhold income tax and pay all the social security taxes from the payment. So moving on to tax 8. This is the next administrative cooperation directive, which is in force and which will be applicable as of 26. And this concerns crypto assets. So tax authorities will be now informed about earnings through crypto platforms, about gains, about transactions. So this will be now more transparent, and investors who are investing in crypto assets can't really escape from unreporting. And this directive also concerns high net worth individuals. It means that tax authorities will exchange information about the advanced rulings related to high net worth individuals.
Just a quick comment about these crypto assets. I don't know how it is treated in Latvia, Lithuania, but in Estonia, the problem is that if you are owning and selling the crypto assets as an individual, it is treated a taxable gain. But the problem is it is not treated as a security, and therefore you have to pay the income tax on the gains, on the profits of those transactions, but you cannot offset it with losses from the sales of crypto assets, and this is a problem. And now, as well, tax authority will get much better and faster information about those transactions, and we have always strongly recommended to those Estonian individual tax residents to continue and move to such trading activity to the companies.
Mm-hmm. Yeah, and there is also a draft bill or a proposal to give some relief to crypto asset tax treatment, so it would be more similar to securities transactions and to be able to use also the investment account in the future. But moving forward with adopted directives, we have this so-called Pillar 2 or minimum tax directive, which is actually in force already. But as Estonia, Latvia and Lithuania have very low number of companies which would be subject to this directive, the Baltic countries have decided to postpone the adoption or implementation of the rules of this directive. This Pillar 2 comes from the initiative of the OECD already quite many years ago, where the OECD proposed to tackle the digital economy. So it means that big giant digital companies need to pay a fair level of taxes all around the world. So this proposal comprised of two pillars, Pillar 1 of digital taxation and Pillar 2 of minimum taxation of big companies. So this Pillar 2 is actually the concept of OECD, but European Union took it over by minimum tax directive, which is now in force. So this minimum tax means that very big companies conducting business in the European Union, which have turnover at least 750 million on a consolidated basis, need to pay at least 50% effective tax rate needs to be at least 50% in each jurisdiction in the European Union. And if in some jurisdictions the tax is below 15%, then the top-up tax will be paid in the parent country's jurisdiction or in the country where this minimum tax reporting is done. So, as I said, this will be postponed. However, it doesn't mean that the other countries which actually apply already this minimum tax directive don't have a right to tax the income which is earned in Estonia. So it means that if in Estonia, for example, since we have this deferred tax system, although we have 20% nominal tax rate, the effective tax rate may be 0 if we don't distribute any dividends. So in order to apply the criterion or to meet the criterion that the tax has been paid at least 15%, it means that right now Estonian companies, those large companies, then should distribute at least 60% of its profits. So it will relieve us, those Estonian companies, from the minimum tax payment in other jurisdictions. As of 2025, when the tax rate will be increased to 22%, then Estonian companies should distribute at least 53% of profits. But this actually concerns only 5 parent companies in Estonia, which would be liable to collect the information and prepare the declaration of minimum tax. And it would concern less than 200 subsidiaries in Estonia, because subsidiaries are actually exempted from this minimum tax obligation if in one jurisdiction the revenue does not exceed 10 million euros and the profits don't exceed 1 million euros. So right now what has been done is that the parent companies in Estonia, those 5 parent companies which are subject to minimum tax, need to appoint a subsidiary in another EU country who is applying minimum tax. And this subsidiary will do the calculations and pay the tax in this country. But we have also another exception for Estonia as well as for Latvia, because we have this deferred tax system. If the tax will be paid in Estonia during 4 years, then there will be no top-up tax payable in the other jurisdictions. So this is a brief overview of the status of minimum tax directive. So what's coming next on the level of European Union? It's more interesting. There are some quite interesting acronyms, so I will just very briefly go through this. These will concern different types of taxpayers in European Union countries. So the first one is the UNSHEL or ADA 3 directive. ADA directives refer to anti-tax avoidance directives. So this is something that has been designed to shell companies, so that the entities in the EU who have no or minimal economic activities will be unable to benefit from the tax treaty, reduced rates or parent subsidiary directive, or from the interest rate directive, which means that either no tax will be withheld or the tax rates would be lower. But in case of shell companies, all those benefits will be refused. So in practice, it would just look like it would be very simple. The country where this shell company is a resident will not issue a residence certificate, or will issue the certificate and it will be said on the certificate this is a shell company and it will not be eligible for tax reliefs.
As a quick side comment, Estonia is quite the typical jurisdiction for the holding companies. And many of the current holding companies could be treated as a shell companies in the future when it will be adopted, based on the current number of these indicators, which we know. It's not, of course, decided yet, not implemented yet. We will see, but there are quite a lot of indicators about the number of employees and the type of active revenue and etc. Where the holding companies are not treated as a shell companies. And as Ursula explained, if it is just purely holding entity, then it will be most likely the shell entity. And it means that the treaty benefit can be refused. It means if I don't know, there will be if a Estonian holding company has listed investment in Swedish stock exchange, and there will be the dividend payment from the listed company in Sweden to the Estonian holding company, then Estonian company cannot submit the tax residence certificate, which means that there will be the full withholding income tax rate on the dividends, not the reduced rate as it is agreed in the tax treaty. So that would be the outcome, but it will take some time to see how what will be the actual impact.
Yes, and these conditions and terms are under negotiation, so it has been decided yet which would be the criterions or gateways to be regarded as a shell company. So the next proposal is has a nice acronym. It's HOT, and actually it stands for Head Office Tax System, and this is meant for small and medium-sized entities which are operating cross-border through permanent establishments. So for smaller or medium-sized companies, if they are operating through permanent establishments in different EU countries, it means that they would have to comply with all those countries' tax laws. So this directive would give an opportunity to interact only with one tax administration, and this would be the tax administration of the head office. So it would be much more easier and would reduce significantly the cost of such permanent establishments.
So it would basically mean like a current one-stop shop for the VAT. It's pretty much a one-stop shop for the corporate tax for those small and medium entities, because it's often quite typical that the company will have a sales representative as an employee in our country, and instead of setting up like a separate subsidiary for each sales representative as an employee or dependent agent as an entrepreneur, it will be much easier to work through this setup, which will create sooner or later a permanent establishment and need to calculate and pay the corporate tax, which is often very, very small amount, to be honest. But the biggest problem is the administrative headache of registering the permanent establishment, corporate tax compliance, and this system would allow to communicate and declare everything through the home tax authority of a head office country. So if this will be applied, I think that could be quite useful for the smaller businesses.
Exactly. Then we have the transfer pricing directive proposal to harmonize transfer pricing rules within the EU. Although European countries, like most of OECD countries, adhere from the OECD TP guidelines, arm's length principle, there are still some differences. For example, how to determine associated enterprises, what is the notion of control, and also there are still problems with double taxation. If in one country there is an adjustment made, but the other country refuses the respective adjustment, double taxation would arise, and this transfer pricing directive should then harmonize all those problems. Then we have another very good proposal, which is called FASTER, and this means better withholding tax procedures to boost cross-border investment and to fight tax abuse. But basically this means that if you are an investor and you have a diversified portfolio, you receive dividends from different countries in the EU, then usually the tax is withheld at source in the nominal amount. But the tax treaties are not, the tax treaty rate is not used at source, which means that then the investors need to go and ask for a refund of the overpaid income tax, which is normally quite lengthy and cumbersome procedure. But now this proposal sets rules to make it faster and better. So first of all, a common EU digital tax residence certificate will be issued, and this means that the taxpayer needs only one certificate. This is this digital residence certificate, and this will make the withholding procedures faster and more efficient. And then there are two ways to avoid this double taxation or receive for a refund. The first one is to give the relief at source, which means that no tax is withheld or the reduced rate is already applied when making the payment. And the other one, if the country doesn't want to give relief at source, it means that it will have to make a refund, but this refund will be then made quite quick, within 50 days. This would also mean that the financial intermediaries like big banks will be required to join a national register of certified financial intermediaries. So there will be quite many changes, but all for a good cause. And for the final directive which I wanted to highlight was BEFIT, which is like another version of common consolidated tax base, but this is aimed to set rules for to determine the tax base of large group companies. Also concerning only those companies whose revenue will exceed 750,000 million euros. So it would mean that there will be only one set of rules to calculate the consolidated tax base, but then this tax base will be reallocated between the countries where this company is active. And then on top of it, those final calculations will be made based on the local laws. So I see it a little bit as an overkill, as we already have a minimum tax directive for big companies. Now, if this BEFIT will come into force, it will just set another set of rules to big multinational companies.
Yeah, the latter would mean pretty much the death of the transfer pricing for those big multinationals. And I'm a bit suspicious about this development because I think under the different acronyms, this consolidated tax base initiative from the EU Commission has been on the table in many forms, like within the last 5 to 10 years, I would say, but nothing actually done. Fortunately, the direct taxation, the corporate tax, is still an authority of each member of state. It cannot be forced by the EU Commission. So, but let's see. At least this is the latest proposal of a consolidated tax base so far, at least.
Yeah, but that's it from me.
So yeah, from Estonia also that's all. I will give a word back to you, Vilma.
All right, so dear colleagues, thank you very much for the presentations. It looks like lots of things going on in Latvia, Estonia, at the EU level, right? So the life of tax advisor will never be boring, right? And I don't know, maybe we allow participants to send the questions by email, or 1-2 questions or comments can be asked now. If you have something to comment, or at least share your feelings. How do you feel about those tax changes in the future and in already established ones? No comments, questions?
Yes, feel free later, if not now in chat section. Feel free.
Okay.
You have a direct information about the presenters and emails. Then if you have any country-specific questions, feel free to send an email also.
Yeah, so we will send the slides, right, to everyone, and there are a lot of technical questions, of course, and sometimes you need time to look through, and just, yeah, please send us you know our comments, and well, I guess thank you very much for participation today, and see you next time. I can see.
Good evening
Okay.
to everyone.
Okay, thank you.
Thank you.
Bye-bye.
Bye.
Bye.
Bye bye.